This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. We're going to look at question 1 from the paper F5 December 2010 exam. So make sure you've got it in front of you. And let's have a look at the requirements. Required: A. Calculate the following for the month of November, showing all workings clearly. 1. The sales price variance and sales volume contribution variance, 6 marks. 2. The materials price planning variance and materials price operational variance, 2 marks. And 3. Labour rate variance and labour efficiency variance, 7 marks. So part A, only calculations, there's no discussion required. And note, the planning and operational is only 2 marks, so it can't be very hard. If it starts taking too long, it's best to leave it and come back later. It's not worth spending too much time for 2 marks. Part B is the writing. Explain the reasons why we'd be interested in the planning and operational variance. Well, we'll leave that till the end, but even so, you should be able to get good marks there, even if you'd no figures from part A to discuss. Anyway, let's make a start. A, part 1, the sales variances. Now, there's a lot to read there, but just note the examiner has helped you. If you look at the top, we're an electronics company. We make 2 types of televisions. Highly competitive, pressure to reduce prices. Producer variance analysis extracts are shown below. We told how many units we made and sold. We told the materials price variance, the labour variance, and they've got notes attached. Now, where this has helped you, note 2 refers to materials price variance. Well, for the moment, I don't care. For part 1, we're doing the sales variances. So note 2 is irrelevant for the minute. And similarly, note 3. That's the labour variance. And we're not there yet. We only want the sales price, sales volume. So the information, it must be simply note 1. And what does note 1 tell us? It tells us the budget sales volume, 1180, an equal mix of the 2. Well, I'll write that down before I forget. The budget sales volume, if it's 1180 and that's an equal mix, for plasma, must be half of them, 590. And similarly, for LCD. So we know the budget sales, we know the actual sales, 750 and 650. We know standard prices, 350 and 300. We know actual selling prices, 330 and 290. And we know standard contributions. So I think we've got everything we need. First of all, the price variance. Now, you can do your workings lots of ways. It doesn't matter as long as you obviously get the same answer. But I'll do it the way that's consistent with the Open Tuition notes. For sales... Oh dear, sorry about that. For sales price variance... sales price. We take the actual sales and we compare the standard selling price with the actual sales at actual selling price, and we'll compare actual sales at standard selling price. Let's do it. First of all, plasma. We actually sold 500... sorry, that was budget. We actually sold 750 units. And the actual selling price, the actual selling price was 330. LCD, we actually sold 650. And the actual selling price was 290. So our actual revenue, 750 at 330, 247,500, 650 at 290, 188,500. So the total actual revenue, 436,000. So that's at actual price. What should the prices have been? Well, plasma, it should have been 750 at, how much was it? 350. LCD 650. This should have been sold at 300. And so we should have had revenue of 262,500, 195. The total revenue should have been 457,500. I've just realised the purchase one. I left a zero off. There we are. So let's compare the variances. For plasma, it should have been 262,500. We only got 247,500. We're different by 15,000. It's adverse. We got less than we should. And similarly, LCD, it should have been 195. We got 188,500. An adverse variance of 6.5. So there are the sales price variances. What about sales volume? And note she wants a sales volume contribution variance. And so again, I'll do it sort of standard rules, if you like. For each type of TV, for volume variance, we should compare what we sold, what we actually sold, with what we budgeted. So plasma, the budget sales were how many? I worked it out earlier, 590 units. The actual sales was 750, so we sold an extra 160 units. And if that's all that had gone wrong, we'd have benefited at standard contribution per unit. And for plasma, the last bit of note 1, the standard contribution was 190. So the sales volume contribution for plasma is 30,400. Favourable, we sold more than we expected. Similarly, LCD, the budget sales again were 590. The actual sales were how many? 650. We sold an extra 60 units. And the standard contribution for LCD is 180. That would have gained us 10,800. The total variance, 41,200. Favourable. So there we are for part 1, the sales variances. Let's now move on to part 2, the materials price, planning and operational variances. Now again, she's helped you. You see at the top she's given you the total materials price variance, 28,000 adverse. Note 2, it's note 2 that is all we need to look at. The sole reason for the variance was an increase in the purchase price of one of its key components, X. Each plasma TV, each LCD TV requires 1 unit. The standard cost is 60, but due to a shortage in the marketplace, the market price went up to 85. So we originally budgeted on 60. It turns out it should have been 85, but we actually paid 80. And so off we go. The planning variance we take our actual purchases. So our actual purchases were how many? At the top, number of units made and sold 1400. Remember, each TV uses 1 unit of X. So we actually bought 1400. And for the planning variance, you're comparing the original standard cost so we originally expected it to cost, what is it, $60? So we originally expected to spend $84,000 for our actual purchases. You compare it with the revised standard cost. So again, for the 1400 we actually bought, it turns out, realistically, we should have paid 85 a unit. And therefore, revising the standard is costing us an extra 35. Now, I'm not stupid. You could actually have written that almost straight down. We actually bought 1400 units and we paid an extra 25 for each. So we didn't pay, but we revised it to an extra 25. Well, it would have given you the same figure. What about operational? Well, here we're comparing what we actually paid with the revised standard. So again, based on what we actually bought, 1400, what should we have paid? Well, the revised standard was 85. And we already know that would have been 119. But now let's see what we actually paid per unit. So actual purchases again, but at actual cost. So those 1400 units, we actually paid, last line of note 2, we actually paid $80 a unit. We actually spent $112,000. And so there we saved 7,000, 7 favourable. And again, the way the information was given, you could have written it straight down. The 1400 units we bought, we'd revised, we should have paid 85, we only paid 80. We saved $5 a unit. And again, the examiner was very kind. She'd already given us the total price variance, 28,000. Well, 35 adverse, 7 favourable. It does check. Finally, for the arithmetic, part 3. These are the labour variances, and again, if you look at the top, she's given us the total labour variance, but referred us to note 3. So let's read note 3. Each TV uses each plasma uses 2 standard hours, and each LCD uses 1.5 standard hours. The standard cost for labour is $14 an hour, and it also reflects the actual cost of labour for company's permanent staff. Now, I'm not quite sure for the moment what that means, but we should have paid 14. It says we did pay 14 for the permanent staff. Next sentence. Because of the increase in sales and production volumes, we also had to use additional temporary labour at a higher cost of 18. So there's where we're going to get our rate variance. We should have paid 14. Permanent staff, we did pay 14. But these extra workers, we paid them an extra $4 an hour. The total capacity of our permanent workforce is 2,200 hours a month, assuming full efficiency. In the month of November, the permanent workforce were wholly efficient. They took 2 hours for each plasma and 1.5 hours for each LCD, which is what they should have done. The total labour variance, therefore, relates solely to the temporary workers who took twice as long as permanent to complete their production. So I'm beginning to see what's happening. The permanent workers were fine. They were paid the right rate per hour. They worked the right number of hours per unit. But because we had to use temporary, we had a rate variance. There was an extra $4 per hour. And there's also an efficiency variance. They took twice as long as they should have done. So let's work out, first of all, how many hours we actually worked. Well, I can work out the standard hours, surely. The standard hours it should have been 2 hours for plasma, 1.5 hours for LCD. So for plasma, how many units did we actually make? It was 750 plasma. It was 650 LCDs. That was in note 1. We'd already found that. Each plasma should have taken, from note 3 at the beginning, 2 hours. And each LCD should have taken 1.5 hours. And so for our actual production, we should have taken 2475 hours. So that's the standard hours for the actual production. However, here's where we had our problem. The permanent workforce, they did work the right hours, but they had a maximum of 2,200 hours. The rest of the work was the temporary workers. Well, they should have taken the remaining 275 hours, but it says in note 3, the last sentence, they took twice as long as they should have done. They took 550 hours. And so the actual hours worked was 2,750. Oops, hours, I'm sorry. So I think now we can sort it out. 2,475 are the hours we should have worked. 2,750 are the hours we did work. So I'll do my efficiency variance first. For efficiency, compare the actual hours worked with the standard hours. The standard hours for the actual production. Now we've got the figure, but I'm just summarising. We actually worked 2,750. It should have been 2,475. It was an extra 275 hours, and if that's all that had gone wrong, you'd cost out at standard cost per hour. And the standard cost per hour was Second line of note 3, $14. So by taking too long, that on its own would have cost us $3,850. What about the rate variance? Now, a little bit unusual, but I think again we've sorted it. For the rate variance, you take the actual hours we worked and compare what we paid with what we should have paid. Well, rather than do great long working, surely here's the actual hours we worked. The permanent workers, they were paid the correct rate, 14, there's no variance. But the other 550, the temporary, they were paid more than they should have been. And so there's where the variance is. It's those temporary hours. There were 550 hours. They were paid 18. They should have only been paid 14. There's where we lost money. $4 an hour on 550 hours is what? 2,200. And again it checks. The total of these two, 3,850 and 2,200, is 6,050. It agrees with the total labour variance at the beginning of the question. Okay, there's all the arithmetic. Now let's turn to part B. Explain the reasons why we'd be interested in materials price planning and materials price operational. 5 marks. We've done the numbers, but to be honest, it's irrelevant whether we'd done the numbers or not. What were the two? The planning variance was really checking whether our budget was right. We'd budgeted 60 a unit, note 2. It turned out the price went up to 85, so we should have budgeted 85 if we'd have planned, if we'd have forecast properly. And that's what the planning variance is checking. The planning variance it checks how well management budgeted or how well management forecast the price of materials. Now, I know it's not management's fault that we were charged more, but clearly when you're doing your budget, you want to estimate as best you possibly can how much we will end up spending. Maybe we'd no way of knowing that there'd be this shortage in the marketplace. But even so, we'd only budgeted on spending 60. It turns out we should have budgeted on a lot more. There's a big difference there, 25. More importantly, though, what about the operational variance? Why are we interested in that? Well, that's checking how well our purchase managers are doing the job. You see, they actually paid 80. Compared with the original budget, we spent a lot more, but that's not their fault. It's because, for whatever reason, the budget was effectively wrong. Realistically, we should have spent 85. If our purchasing people only paid 80, they've actually done rather well. So operational, it checks how good a job our purchasing managers are doing. Now, although I'm not going to write more, I think here you've still got time. If you had done part A2, which we had, You could have put those figures in just to prove you knew what we're talking about. That they'd, for planning, they'd forecast 60. They should really have forecast 85. For operational, I've said it, but I'll repeat. The purchasing people should have spent 85, but managed to buy it for only 80. They've done well. So there we are.